Roger refinanced his home in 2012 at a fixed rate of 3.375% and spent the next 13 years aggressively attacking the balance, putting every spare dollar, tax refunds, bonuses, side income, toward extra principal payments. He proudly made his final payment in 2025, 13 years ahead of schedule, and threw a small mortgage burning party with his family to celebrate. His neighbor Teresa, who refinanced at the same rate, the same year, made only her required minimum payments for those same 13 years and invested every extra dollar she would otherwise have put toward the mortgage into a diversified index fund instead. When Roger proudly announced his mortgage was finally paid off, Teresa did the math on her own accounts out of curiosity. Her investment portfolio, funded entirely by the payments she never made toward extra principal, was worth $312,000. Roger's version of the same 13 years had produced a paid-off house and zero additional investments. This runs against one of the most emotionally satisfying pieces of financial advice in America: the idea that an early mortgage payoff is an unambiguous financial win, deserving of celebration and treated as one of the clearest signs of financial responsibility. The emotional case for it is genuinely powerful. Debt feels bad. A paid-off house feels like safety. But the purely financial case, separate from the emotional one, tells a very different story once you actually run the numbers most people never bother to calculate. The math underneath this comes down to a simple comparison that gets skipped over constantly: the interest rate on the mortgage versus the return available by investing that same money instead. Roger's mortgage rate was 3.375%. Every extra dollar he put toward principal was, in effect, earning him a guaranteed 3.375% return, since that's the rate he stopped paying interest on. Every extra dollar Teresa invested instead, in a diversified index fund averaging roughly 8% annually over that period, was earning her more than double that rate. Over 13 years, that gap between a guaranteed 3.375% and an average 8% doesn't just add up, it compounds, and compounding on a meaningfully wider rate gap over more than a decade is exactly what produced Teresa's $312,000 versus Roger's zero. This isn't a hypothetical quirk of one favorable market stretch. It's the mathematical reality of what's sometimes called rate arbitrage, borrowing at a low fixed rate while investing at a historically higher average rate. It only works and only makes sense under specific conditions, and those conditions matter enormously. A mortgage locked in at a historically low fixed rate, the kind many homeowners secured between 2010 and 2021, creates an unusually favorable version of this gap. A mortgage at 6% or 7%, which became common after 2022, narrows that gap considerably and in some cases erases the financial advantage of investing instead almost entirely, since the guaranteed return from paying down a higher rate mortgage becomes much more competitive with average market returns. There's a second condition that matters just as much as the interest rate itself, and it's the same discipline requirement that shows up in nearly every version of this kind of comparison. Teresa's $312,000 wasn't produced by simply not paying off her mortgage early. It was produced by taking every dollar she would have put toward extra principal and actually investing it, consistently, for 13 straight years, rather than spending it on a nicer car or a larger vacation because the money wasn't earmarked for anything specific. Someone who skips extra mortgage payments and simply lets that money disappear into everyday spending ends up considerably worse off than Roger, not better. The financial case for investing instead of prepaying only holds up if the money that would have gone toward the mortgage is actually redirected into something that grows. There's also a real, non-financial value to what Roger did that a pure spreadsheet comparison doesn't fully capture. Being completely debt-free carries genuine psychological weight, reduced financial anxiety, one less required monthly payment regardless of what happens to his income, and a kind of unconditional security that a fluctuating investment account, however larger on paper, doesn't provide in exactly the same way. Roger sleeps better at night knowing no bank has any claim on his home, and that peace of mind, while it doesn't show up in a net worth calculation, is a real and legitimate part of the decision that shouldn't be dismissed simply because it doesn't compound the way an index fund does. The households for whom aggressive mortgage payoff genuinely is the better decision tend to share specific characteristics. Someone carrying a mortgage rate at or above 6.5% to 7%, someone within a few years of retirement who values the certainty of eliminated housing costs over continued market exposure, or someone who has demonstrated, honestly, that they won't actually invest the difference if left with extra cash each month, are all cases where prioritizing the mortgage payoff makes sound financial sense on its own terms. The mistake isn't choosing to pay off a mortgage early, it's assuming that choice is automatically and universally the smarter financial decision, applied identically regardless of the interest rate involved, without ever running the actual comparison between that rate and what the same money could otherwise be earning. Roger never ran that comparison. He simply absorbed the widely repeated wisdom that debt is bad, and paying it off faster is always good, without ever calculating what he was giving up at a 3.375% rate specifically, a rate low enough that the math tipped clearly in the other direction. Roger still says he has no regrets about his mortgage-burning party, and there's a strong argument that he shouldn't. But when Teresa mentioned her $312,000 at a neighborhood gathering a few months later, Roger, for the first time in 13 years, did the math on his own 3.375% rate against what the market had actually returned over that same period, and found himself doing quiet mental arithmetic for the rest of the evening about a decision he'd never once questioned until he heard someone else's number out loud. The lesson isn't that paying off a mortgage is wrong. The lesson is that every financial decision has a trade-off. Money used for one goal cannot simultaneously be used for another. The smartest choice depends on the numbers, your personality, and your financial situation. Roger chose certainty and emotional peace. Teresa chose higher potential growth and accepted more uncertainty. Neither decision was automatically right or wrong. The important part is understanding exactly what you are choosing and what you are giving up.